This podcast episode is for investor education purposes only and is not intended to provide and should not be relied on for investment advice. Consult your personal investment advisor before engaging in any securities transaction.
The markets don't like $100 oil. The markets don't like uncertainty, and they don't like higher interest rates. On this week's show, we'll look at what's priced in and if we'll see a true correction before better days can return. Welcome to the Wise Investor Show podcast. I'm Chase Hinderstein. Earlier on this week, the markets were finally getting a bit of positive momentum, looking a bit beyond the current situation, the war in Iran, whose effect on the economy continues to at least be in question. But amidst the brief rally, we got some economic news leading into the March Fed meeting, and that rally was derailed, I'll say, at the time by the latest inflation report in the form of the February Producer Price Index, which showed higher than expected both in the top line and in the core readings of inflation. And this month's action on oil, of course, due to the closure of the Hormuz Strait, is a good example of why economists use the core reading. It strips out the cost of food and fuel from the data. The move in oil prices are clearly due to the trouble in the Middle East, and the duration of that, the higher prices, how long they'll last, well, that's unknowable right now. But also the spike in oil prices can eventually work their way down, becoming higher prices within the cost of other goods, as their costs of production and the transportation of them would also be inflated. So one reason for not using that, for using the core rate, is you don't want to double count the effect of higher oil prices. And I've seen some people saying that it's incorrect to say that the Strait of Hormuz is closed. In fact, our Treasury Secretary said that, and he went on to point out that the strait is not completely closed, that Iranian oil tankers are actually getting through today, which I thought was kind of a funny way to dispute the severity of this closing. But still, while it's often cited that 20% of the world's daily oil supply typically transits through that strait, that too is a bit misleading, as a large amount of what Saudi Arabia typically would ship through the Gulf can be diverted through in this east-west pipeline they have. It gets diverted and it actually still gets out there. It hits the sea as it's loaded up instead of the Persian Gulf. It's loaded up in the Red Sea and gets out there. So the Saudis are actually doing quite well in this scenario of higher prices and keeping most of their volume intact. Still, with reports now that the Pentagon has requested an additional $200 billion in funding to cover the costs of the war, the markets are starting to think that this maybe will last longer than just a few weeks. In the end, it's not a matter of that huge costs or how long the troubles actually persist, but simply whether or not they can get the shipping lanes back open. As for the inflation data and the monetary policy, we also had a Fed meeting this week in which they didn't move interest rates at all, just as planned. The day before the meeting, as I said, we got the February Producer Price Index, which was hotter than expected, with a core reading up 0.5% for the month. You can do the math to see how much that would annualize out. The consensus estimate was that it would be 0.2%. So it was also the highest annualized three-month pace of producer inflation since May of 2022, which was the peak of inflation during the Biden years. So the market didn't like that, and it led into an ugly session on Wednesday with the Fed's results coming out later that afternoon. And the notes on the meeting and the press conference that followed really ramped back the expectations for further rate cuts this year, as they demonstrated that now 7 Fed officials forecast holding rates steady for the rest of the year, while 12 of them expect one cut still this year. And that's a big shift from the expectations 6 months ago, which were for 2 or 3 interest rate cuts this year. Jerome Powell emphasized that economic activity is still expanding at a steady pace, but that job gains remain low, and he believes that unemployment will remain anchored here at 4.4% for the remainder of the year. That, too, may be optimistic, as the effects of AI are still rippling through the economy. And Thursday morning, it was reported that HSBC Bank is going to lay off 20,000 employees, not all Americans, maybe mostly not Americans, but a great example that they're going to lay off 20,000 people because their efforts, those employees' efforts, are being replaced by AI at the bank. The more stories that come out like that and the increased pace at which they are appearing, well, we can see what will happen to unemployment if we can hang on to that 4.4%. But while Powell kept his unemployment projections flat, he also said that their inflation projections for the rest of the year and for next year are higher today than they were at the end of last year. He went on to say that while the median forecast of the Fed didn't change, quote, there was a meaningful amount of movement towards fewer cuts among the members, end quote, which I think is the standout quote for the day. Along with that tidbit, though, he also said that, quote, the economic effects of the war could be bigger or smaller, or could be much bigger or much smaller. People are writing something down. Pause the quote. He means that the Fed members are writing down their projections as required. Continuing the quote, people are writing something down, but they have no conviction in it. Still, as ugly as it's been recently, it's not even a true correction in the markets yet. The S&P 500 is now down about 4% for the year, and it's off its recent all-time high by about 6%. And we are getting closer to the low that the market saw in November, which I'm hearing more and more is the kind of the crucial point people are looking at to see if the S&P can hang on to. And we're about 1% away from that today. So I guess the theory is if we break through the November low, then we're really off to the races as far as technical trading is concerned. It's not really what I put a lot of stake into. But oil here, though, is also well off the panic high that it made when we initially attacked Iran. But it's been edging higher, as you're well aware. And what we have no conviction is knowing if it will be here around $100 a barrel or even higher in 3 or 4 weeks or 3 or 4 months, or if we'll see the volumes flowing again in a few weeks. And what we're seeing is that cash is largely flowing to the sidelines and maybe into some short-sighted energy trades, but there isn't an overall flight to safety other than cash. Gold is about 20% off its recent highs right now. Bonds are also lower, meaning their yields are up. Money is not going into bonds. And that's a reflection of not just the war, but also shifts in monetary policy expectations as much as anything else here. And if you only have 2 seconds at any point in time, you wake up in the morning, you only have 2 seconds to consider what's happening in the markets. At this point, I think the best indicator you can start off with is a glance at the yield on the 10-year Treasury. That bond is yielding 3.96%, or was yielding 3.96% at the end of February, right before we went into Iran. But today it's up to 4.3%. And I've made references on a few occasions to how that yield starts to impact the stock market when it starts to exceed 4.5%. And according to a research piece published by the St. Louis Fed and also an article on tradingeconomics.com, in the 70s and early 1980s, the 10-year Treasury spent extended periods of time well above 4.5%, ultimately peaking above 15% in 1981. And this era was dominated by high and volatile inflation readings, multiple oil shocks, and aggressive monetary tightening. Equity markets delivered really weak returns, real returns at least, especially adjusted for inflation, despite having nominal earnings growth, as the multiples, the valuations were really compressing sharply, and inflation eroded real purchasing power. Stocks struggled not merely because rates were high, but because real rates were unstable and inflation uncertainty dominated investor expectations. It's really the sustainability of valuations that the higher yields attack here. And the markets can do well with higher interest rates. They just need growth in earnings to compensate for that. While the same stock may trade at a lower valuation than we've enjoyed recent years, if you don't actually see the growth to sustain those prices. Now, in a contrasting piece to make that point from an article or a research piece from NYU, it pointed out that, by contrast, during the mid-1990s, The 10-year Treasury yield was also ranging basically between 5 and 7%, but U.S. stocks performed pretty well. And in that period, higher yields reflected strong productivity growth, what was considered credible Fed policy, and contained inflation expectations rather than macro instability. Earnings growth was strong enough to offset higher discount rates, allowing valuations to remain elevated and at times to even expand. So as long as the growth is there, equities can still provide strong real returns. And we've said stocks can be one of the best hedges against inflation, but that was after a period of valuation contraction that preceded it. And today, we're going into this at roughly the higher end of historical valuations for stocks in general. One other element that is mentioned in all these pieces is that productivity growth was a defining characteristic of the periods where stocks were still doing well in higher rate periods. U.S. productivity actually notched a bit lower than expected in the most recent report. But kind of the prevailing expectation now is still that the application of AI will translate to higher productivity numbers throughout the economy, which circles back to the ongoing debate underlying these markets beyond the headlines of the war. So I'm going to hop into a quick break here, and when I get back, I'll give an updated look at one of those names powering that productivity AI game. For the Wise Investor Show, I'm Chase Hinderstein, and I'll be back with that in a moment.
Every asset class, equities, metals, oil, and treasuries seem to trade more and more like crazy meme stocks. Discipline and patience are lost arts. How do you keep focused when others don't? Tune in every week as we discuss the latest financial trends and what investors need to know. To keep your eye on the ball and become a better informed, wise investor, listen to us at The Wise Investor Show at raymondjames.com/The Wise Investor Group. Or just find us on your favorite podcast app. Raymond James & Associates Incorporated, member New York Stock Exchange, SIPC.
The information contained in this podcast represents the opinions of the hosts and guests and does not necessarily represent the views of Raymond James & Associates, Inc., the Wise Investor Group, or their respective affiliates and employees. This podcast is for investor educational purposes only and is not intended to provide, and should not be relied on for, investment advice. The contents of this podcast do not purport to constitute a comprehensive summary of all information necessary to base an investment decision. Past performance is not a guarantee of future results. Securities mentioned in this podcast may not be suitable for all investors. Seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your individual situation. Discuss any tax or legal matters with the appropriate professional advisors. Raymond James & Associates, Inc., member New York Stock Exchange, SIPC.
Welcome back to the show. Talking about this stock might qualify as dull these days, as I'm going to drill down into one of the biggest companies, the biggest company in the world, and maybe one of the most widely held stocks. But first, my usual disclaimer here that it's also held in my own accounts and those that we manage for our clients. It's been flat at best recently after one of the most remarkable runs in market history. So I'm going to share the update that they provided this week and what it may take to get this stock going again. But it's from a biased point of view, of which I hold, that believes that it's going to get going again. So do your homework and consider multiple sources before you buy it yourself. I'm a little bit shy of being radically bullish on it right now, and we'll take a look at why. And if you didn't guess, I'm talking about NVIDIA here, which hosted their big conference this week. It kind of harkens back to when Steve Jobs used to hold those big reveal events for Apple. And they provided an update on their existing lines of revenue as well as releasing some new products. And their CEO shared his thoughts on where the company and the industry is going, which is providing the chips that power everything that is AI, that is cloud, that is the central nervous system of everything inside those data centers you see popping up all over the place. Now, you may not remember this, but until about 7 or 8 years ago, NVIDIA was a chip company known for their high-end graphic processors, mostly those that were used in high-end gaming platforms, And that was nice. That was their niche, and they did well with it, but not like they've been doing recently. The revolution was when they used their high-end designs, their leading cutting-edge chip designs, to provide the most sophisticated chips to make the management of incredibly large data sets in the cloud and ultimately large AI models possible. Now, their CEO, Jensen Huang, spent some time talking about graphics this week, which, as a pure part of the business, it's really less than 10% of revenues today. But that's also now tying back into the AI world because, as he demonstrated, they're using more and more artificial images and moving images. We might be replacing actors with AI soon. So that requires a lot more computing power and clarity in the graphics. But on the other hand, the challenge today is that while they're the leader in sales and in future orders for chips, they're also somewhat restricted on what they can sell to who. And there are some burgeoning alternative options out there, especially perhaps, and this is debatable, alternatives that are being produced by China who doesn't have the free access to NVIDIA's most advanced chips. And the single greatest risk to the NVIDIA story isn't that the demand for chips will not be there, at least over the next couple of years. Not that it's not a risk at all, but that's not the single greatest risk. It's not that the spending won't continue, but that the breakthroughs elsewhere may allow more competition, more cheap alternatives, and maybe attack NVIDIA's 70%-ish margins. Huang pointed out the degree of sophistication with which his chips work, fusing structured data sets, managing huge amounts of known information, along with generative AI, powering the AI to draw its own new conclusions as a way to keep them well ahead of the competition and keeping them indispensable as a leader at the center of this megatrend, saying, quote, "There is not one software engineer there who is not using AI to help them code," end quote. And this also speaks to the productivity gain I was referring to earlier. He said, quote, "You don't ask it who, what, when, where, how. You ask it to create, to build," end quote. And now it's able to take it from there. It's an, quote, AI that was able to perceive and became an AI that could generate, which became an AI that could now reason. And an AI that could reason now becomes an AI that can do work, end quote. Then he went on to feature a robotic snowman from the movie Frozen, if you're familiar with that, came onto stage. And he said you can imagine a bunch of different characters like this strolling around Disney World autonomously. But the real emphasis here was on the robotic applications that would revolutionize manufacturing, and also how these NVIDIA chips are essential to advancing self-driving cars, as that progression from perception to generation to reason has a real needed impact on how these vehicles will overcome the questions that probably we all share about how self-driving car is going to navigate a new construction project, a pothole, a light that's not working, and every other challenge that a human driver navigates every time they get behind the wheel. As for the dollars and cents part of it, per an article regarding the conference in the Wall Street Journal this week, Huang projected that just 2 of their chip families alone will exceed the total revenue estimates that Wall Street currently has for the company through 2027. The article pointed out that the stock has stalled out here, and maybe the biggest challenge is that it's so widely held that total investments, all investments kind of need to catch up to allow more allocation to such a huge, widely held stock. But the journal also pointed out that NVIDIA's pace of innovation continues to outstrip the competition, and cited an analyst from Morgan Stanley who said basically that when customers try to go to other solutions in order to try to save on costs, they basically lose out on the end results, and they end up cycling back to NVIDIA, where their biggest challenge is keeping up with the current demand. At JP Morgan, in their report regarding the conference, they pointed out that the $1 trillion in orders from those 2 chip families isn't an aspiration for the company, but actually a floor on what JP Morgan expects NVIDIA to deliver over these next couple of years. They also note that NVIDIA is being more shareholder friendly, which is critical, that they're stepping up to a 50% or better return of free cash flow to shareholders in the form of dividends and buybacks from the 42% of free cash flow that they delivered last year. And for what it's worth, FactSet estimates that NVIDIA is going to generate $231 billion in free cash flow this year, which equates to a bit more than a 5% free cash flow yield. And half of that is going to these buybacks and what's now a modest dividend. But they also have that free cash flow estimate doubling over the next few years. Now, the biggest challenge for the stock may not be what happens in 26 and in 2027, but then what comes in the years beyond that. Eventually, all these big AI models and the spending, they have to be completed, and the spending cannot continue at this pace indefinitely, as already the main scrutiny is if these hyperscalers are ever going to see a reasonable return on what they have scheduled to be spent. But we have to now start looking beyond the demand of building out these systems, these models, and how much more can continue through the continued development of the more advanced automated systems, the applications of the chips beyond just the AI models. And I'm going to say they're going to spend $3 or $4 trillion at least on these models. But after that money is spent, where's the revenue going to come from? The robots, the autonomous cars, and everything else that comes in the Jetsons-like future after that, I guess. The stock isn't actually remarkably expensive here. It's 22 times this year's expected earnings, 16 times the estimates that FactSet has for next year. But it's also tough to imagine the pace can resemble anything like it has over the past few years, the revenue growth, the explosive growth in the stock. As the markets now do appear to already be pricing in the reality, it's almost like a drug stock when you have a blockbuster drug that's making tremendous amounts of revenue, but that patent cliff is down the road. In this case, it's not necessarily a patent cliff, but rather the demand does not go continuously indefinitely. So what happens after the biggest period of spending does begin to tail off, whether that's in 2029, 30, what have you, the market is to some degree trying to already get ahead of that. To find value in it, it's going to have to come from a combination of continued spending from those other sources of revenue, as well as a continued increase in the return of capital to the shareholders along the way. So it's key that all the free cash flow isn't just going back into capacity right now, but they're going to have to continue to reward shareholders on the greater amounts of total free cash flow and the percentage of it that's returned to shareholders. And while that looks like a decent case for the coming years, it is certainly not a layup from here. All right, that's it for me this week. For the Wise Investor Show, I'm Chase Hinderstein. Thanks for tuning in.
The information contained in this podcast represents the opinions of the hosts and guests and does not necessarily represent the views of Raymond James and Associates, Inc., the Wise Investor Group, or their respective affiliates and employees. This podcast is for investor educational purposes only and is not intended to provide and should not be relied on for investment advice. The contents of this podcast do not purport to constitute a comprehensive summary of all information necessary to base an investment decision. Past performance is not a guarantee of future results. Securities mentioned in this podcast may not be suitable for all investors. Seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your individual situation. Discuss any tax or legal matters with the appropriate professional advisors. Raymond James and Associates, Inc., member New York Stock Exchange, SIPC.